Is everyone okay if we record? Okay.
Yeah, whatever. Sorry.
Angela, I'm gonna install Zoom on your computer.
Okay.
Yeah.
Keep doing what you're
Make then I think another like minute or two, and even if everybody's not here, just go ahead and get started and as people keep going.
Okay, sure. Sounds good.
You were probably going to pass these out, probably, right?
Yes.
Well, I'll just grab one real quick.
To grab, yeah. The overmade copy of Breakfast Miniature.
Well, those are good little reference sheets. We'll just keep what we don't need.
Yeah. Yeah, even for just meetings about applications for owner built housing, you could give those out.
Oh, that would be awesome.
Yeah.
Yeah. They don't want it. They won't. We still can.
We are pretty good at that. All right, Nathan. Yeah, whenever you're ready. So thank you, both of you, for coming in, and for those on Zoom, thanks for coming as well. Kind of the structure of this, we'll have each of our three presenters do a little mini presentation, have a little bit of time for questions, and then we'll have time for a lot of questions towards the end. And so Nathan and Carrie have come in from Billings. They are with the Home Center. They're both HUD-certified financial counselors, and Christopher Downs is a mortgage loan officer with Movement. What is it again? Movement Mortgage. Okay. So yeah, Nathan, go ahead and take it away.
Thank you. Yeah. So I'm just going to kind of get started here for my presentation. I'm just going to talk a little bit about homebuyer readiness and like whether or not, you know, if you're ready to buy a home, like just some of the more personal questions you kind of want to ask yourself, and some of the more life kind of questions you want to ask yourself on just where you're at and like how you're going to be approaching that. Slide. Oh, there we go. Okay. Yeah, so a lot of the times this question kind of boils down to whether or not you want to be renting versus buying your own home. That's usually kind of like the big question that a lot of people face, like especially when they're kind of working through, if they're in a situation where maybe they're looking to move soon, or maybe they're thinking about moving soon, but they're not sure if they want to buy a home yet, or are they ready to buy a home. A lot of time it boils down to some of these three very key points, among these being like your current life situation, right? Like, are you looking to be moving again in the next maybe 5 years or so? If you're looking to be moving relatively soon, maybe buying a home is not quite the right option for you yet, or maybe you're not quite in a life situation where that's something that's appropriate for where you're at. But maybe it is. Maybe you are planning on sticking around in an area for 5+ years, or however many you kind of come down to what you're kind of thinking, or your foreseeable future, that kind of measure. Another one is personal needs. A lot of people tend to find a lot of satisfaction in owning their own home, and fulfills different requirements they have for their current life situation and just what they're where they're at and what they want in life. And I'll kind of touch on a couple of those factors here shortly. And it also boils down a little bit to that future planning kind of thing, like what is your family planning looking like in the future? Are you going to be starting a family soon, so maybe you want to be looking for a home that's maybe more in line with those goals, or maybe you don't have any plans for a family yet. So maybe if you're not quite ready to buy a home that's oriented for a family, maybe that's something that kind of incorporates and works into that decision. The main kind of pros here that I really want to kind of build off here. First one, definitely is building equity. That's a huge pro when it comes to owning your own home. A lot of people list that as their #1 reason why they want to buy a home. A lot of people feel that it's not, that instead of paying like a landlord rent every month, they'd rather be just using that money to go paying towards a mortgage, to building that equity in their home. That's really important for a lot of people, and it's something we definitely stress to all of our clients that come through, just kind of important things to think about, and a huge pro when it comes to buying your home. Another big positive as well comes from the tax breaks you get from owning your home too, being able to write off certain interest costs and that kind of thing. There are certain tax breaks that come with that, but with owning a home, there are certain tax responsibilities that come with that as well. So that's another thing we kind of have to factor in. A lot of people like the creative freedom that comes with owning their home, own a home. And this is kind of reflected in a couple of these points, but a lot of people like that feeling of the home being theirs, and that it's someplace that they can go back to and they can make changes to as they wish. They don't have to worry about like a landlord or property management company having any rules to like what they can and can't do with the home, right? There's also the privacy of owning your own home, just the kind of level of not having to worry about, you know, a landlord giving you a notice to be coming into your property next 24 hours or anything like that. A lot of people find that part of owning a home a pretty big deal. So that's another kind of big one that we have to try and highlight. But also one of the main ones is security. And this is something that I think we need to talk a lot more about, is just the security in owning your own home. It's when you're renting your own home, a lot of the times it can be what we would call like a less stable housing option. Depending on the circumstance, you know, your landlord can maybe give you a no fault eviction, in which case, you know, you might need to leave your place in the next 30 days or something along those lines. I mean, more and more common recently. So it's something that whenever you're owning your own home, it's something, you know, you don't really have to worry about. As long as you're keeping up with and paying your mortgage, you're entitled to be living in your home for as long as you're there for it.
Can I do this?
Absolutely, yes. Feel free to take a seat.
Hi. That's okay.
Grab this. Also, a big pro that comes with owning your own home is that sense of community gain. A lot of people, and this is especially important when you start looking into buying your own home, is just that kind of community that you're going to be wanting to join. What factors into that community and the kind of positives that go along with that. That's another key reason why a lot of people really tend to kind of gravitate towards owning their own home. So it's another huge plus. Another big plus is that it contributes to the local economy. This kind of factors into that community sense of purpose. You know, whenever you own your own home, you become part of that community and you're supporting your local economy. Various different ways that you're maintaining and keeping up with your home kind of factors into your local community and your local businesses. There's also just the general pride of home ownership. That's a huge one. I hear from a lot of people that they just want something that they can go back to and call theirs. Like there's a certain level of pride that comes with that. And a lot of people find that just the task in owning a home is something that they look forward to, even that they don't mind, you know, the kind of upkeep and maintenance that's required for like living in their own home. It's something that they look forward to, that they take pride in. So that's another huge reason that home ownership really is kind of like, there's a lot of pros that go into that. Another one is just like financial reasons, like maybe, you know, it's a good time to buy a home for some people in certain situations. It can be, depending on like the interest rates and the state of the market, you know, it could be a good time to get into a home at certain points. I know recently we've had a lot of fluctuating interest rates, so that certainly kind of changes some factors with there, but that is another kind of idea to get to help with whether you want to buy or rent a home. And the last big pro that I want to go over is just kind of like the financial portfolio piece. It's just like a lot of people like owning a home because it is one of the more stable assets that you can own and investments into your future you can make. You know, home prices don't necessarily guarantee to always go up. That is a risk, and we'll kind of get into that in a little bit. But traditionally, owning a home has been one of the most stable kind of decisions you can make as far as like asset generation. Just like a pro as far as owning your own home. Now, what about the cons though? There are quite a few cons with owning a home and potential things to really consider when you're trying to decide if you want to rent or own your home. The biggest one that I try and stress to people are repair costs, maintenance costs, upkeep, those kind of costs. A lot of people cite recent increases in rent as reasons why they don't want to rent anymore, why they rather buy a home. But a lot of the times people don't factor in all these other kind of costs from repair and upkeep and maintenance costs associated with the home. That's the stuff that can really push people over the edge for affordability when it comes to owning your home. I'm not saying that, if you're, you can't, own a home just because of these kind of costs, but you have to factor them into like your decision making, deciding if it's time for you to buy or own a home. Another thing that comes up for people is lawn care. Believe it or not, some people don't like having to take care of their lawns and other kind of requirements for keeping up with your homes. Just the kind of maintenance that's generally required. It can be a lot sometimes. A lot of rental companies, will mow your lawns for you or whatever, depending on what kind of situation you're in. So some people, don't have to deal with that kind of stuff. There is, of course, the risk of depreciation that I had mentioned earlier. That's another kind of big factor to consider whether it's time to rent or own your home. So that's just another one of those risks. Another one are potentially neighbors, right? Like sometimes your neighbors, they don't really like it. So that's why I really kind of stress when it comes to this kind of factor. But when you're really looking to buy a home, go out into your community that you're looking to buy in. Definitely get a feel for the neighborhood, get a feel for the neighbors. If it's something that you like or see yourself being a part of, that's going to definitely factor into what you end up deciding. The next kind of big point that I want to kind of bring up is when you're on your home, you have less flexibility. I know earlier we talked a little bit about how owning your home is a more stable housing option. Well, with that also comes less flexibility to be able to kind of pick up and move whenever you want. There are very significant upfront costs when it comes to owning your home. That kind of includes moving costs and selling costs of having to move from a certain area to another area. Part of those moving costs and selling costs can be pretty high and pretty prohibitive for a lot of people. So just important other things to kind of keep in mind there. There is also the cost of taxes, having to pay your property taxes. Having to keep up with those can be a pretty big cost for a lot of people. So that's another one that we kind of have to keep in mind as well. Also, having to pay more for insurances. There are a lot of different kind of insurance out there that you have to keep up with and pay for when it comes to your mortgage. But certainly, insurance costs can increase or decrease depending on where you're at in the current situation. It's just another kind of big thing to keep in mind. There is also, of course, the risk of foreclosure. Going through a foreclosure is something that I hope anybody ever has to do, but it does happen. And foreclosures are one of the most stressful experiences somebody can go through. So just making sure, if you do end up buying a home, being prepared for that possibility and knowing what your options are, where you can turn to if you do have to face those kind of problems. Like I mentioned earlier, it is a long-term, I'll get the questions in a little bit.
Okay.
There is also kind of like the long-term commitment aspect of owning your home as well, right? So it is a long-term kind of commitment that we've already generally been talking about. There's also this down payment and loan fees. A lot of significant blocker to people buying their own home are going to come from down payment and closing costs. Those are kind of the biggest things that kind of keep people from just buying a home in a particular situation. So being prepared for that while also not leaving you completely drained for finances is also a pretty big important factor to keep in mind. Now, the next thing I just kind of wanted to briefly cover is just kind of like how lenders decide the plan. A lot of the times when it comes down to things like how much debt you have compared to how much income you have and whether or not you can afford to take out a mortgage. A lot of this information is going to be in the slide, so certainly check back through there for more information. I just kind of wanted to just talk a little bit about that. Kind of bring up a little bit of an example. For FHA, for instance, their debt ratios, they require you to have, make sure that if they do give you a mortgage, it's not going to go over that 43% debt to income limit. Basically, what that kind of encompasses is like how much total debt you can have on top of a mortgage and still keep up with those payments. So making sure that you're able to afford those is another kind of big hurdle that it comes to owning a home. Another kind of important factor that we want to talk about just a little bit of them as well that kind of ties into that is just how much you can afford for a mortgage just based on income. A lot of the times it'll come down to two big factors: how much you're income and how much debt you have that you can afford to take out. So when it comes to that income, that's kind of the other piece of that. There's the debt to income, and then there's also the income factor that we consider as well. Now, the last thing I really want to cover is just going to be a brief overview of like the home buying team. I know Chris, when he comes up here, he's going to have a lot more to say about like the process involved, but just a couple of the people I wanted to kind of bring up. First off, you have your home education counselor, like myself. I'm a HUD-certified housing counselor. A lot of the times people choose to pursue homebuyer education as a way to kind of understand the process more and understand what their options are and understand where they stand. That me or somebody like Carrie or is somebody that can help you in that process, kind of see where you're at, what you're looking for, just things you can improve on, that kind of stuff, just kind of really helping you assess your individual situation. There is also people like the lender, people like Chris, who exist to kind of help give us those kind of mortgages and give us those loans, so that we can go out and buy the house that we're looking for. They're going to be a lot of the times the people that you really work with and get a lot of information from, just what they need, what you can work on as well, that kind of stuff. They can give you a lot of good information of like where you're kind of sitting. There's also the real estate agent, somebody that really helps guide you in finding the right house that you're looking for. A lot of the times it's going to boil down to you giving them information as far as what you're looking for in a home, where you're kind of looking for, what your price range is. That's another big one that you should be bringing up to like your real estate agent. And then they represent you as well. I strongly encourage everybody, if you are looking to buy a home, really work with a real estate agent to represent you as the buyer in that process. You're really going to want somebody that's really in your corner to give you that help. The last couple of people that I wanted to touch on are people like the home inspector. I strongly encourage anybody that's going to be buying a home to get a home inspector. Get your home inspected. They work for you, and they work to find the problems that you need to be aware of in your home, or some of the little problems that maybe are not quite as big of a deal. A lot of the times they can easily point out big problems that might come up that you're going to need to be aware of. Maybe replace, maybe some problem with some foundational issues or something along those lines. Like, you really want to get that home inspection so you know exactly what you're getting into when it comes to buying a certain home. Another person that plays a part in this team is the appraiser. Typically, this is somebody that's going to be hired by the lender, and they're going to go out and make sure that the home is as described for what the loan you're going to get, or the house is going to be worth as much as you're looking to pay for it. It is somebody that you're going to end up having to pay a fee for usually, but that is somebody that is hired by the lender to take care of those kind of problems. There's also the title closer, and this is somebody much more involved in like the end of the process, where they're kind of like facilitating the transfer and kind of going back through and checking through any potential legal issues or any other kind of title issues that involved, and really facilitating that transfer and making it known to the state or county or whoever's kind of taking care of those. That's pretty much it for my section. I guess before I give it over to Carrie, I just kind of wanted to check in on some quick questions or anything in particular that anybody had. Maybe in the chat, did we have anything else? Do you have a question back there?
Well, I just, to be clear on, because I don't really know any of this stuff. So
sure.
what does foreclosure mean? What is that?
So a foreclosure is whenever you're falling behind on your mortgage, after you're a certain number of days delinquent, whoever is your loan servicer, so whoever owns your mortgage, might decide that you're not going to be paying it back, and they want to repossess the house. Basically, they want to take it back. They want to take it back, sell the house, and try and recoup some of their losses, right? So that's kind of the thing that we're really trying to avoid when it comes to like owning your home. So that's why we strongly encourage people not to stress themselves too thin when it comes to buying a home. Also making sure to know what their options are, things like loan forbearance, things like loan modification. A lot of loans like FHA loans require loan servicers to have certain options for you to be able to pursue at a certain time and give you notification of what your options are. So that's kind of like the big stressor that I wanted to put into forbearance, is just really, or into foreclosure, is just really to know your options when you're signing up for that mortgage. Does that answer your question?
Yeah, it does. Thank you.
Thank you for that. It's a good question. Mm-hmm. Was there any other questions that you guys had, or we kind of good to go? I'll move over. All right. Well, I'm going to turn it over to Carrie.
If I could just add a note to what you said.
Yeah, absolutely, Chris.
It would just be, foreclosure is a really scary word, and you think, oh my God, if I miss a payment, they're going to take the house back. You're going to go a long way down that road before they take the house back. They're going to do everything under the sun to try and help you in some way, shape, or form keep the house, because it's going to cost them more money to take it back and sell it than it is to work with you. So just bear in mind that that's not like you know, oh no, I missed my mortgage payment, and now he's banging on the door and he's gonna,
Right.
you know.
Right. I think it's like 90 days or something like that you have to be delinquent before they can like start proceeding like pre-foreclosure or something like that. I know there's like there's certain requirements and it changes state to state as well. So that's something else to keep in mind when it comes to that foreclosure process. But yes, it is more of like a long drawn out process that can take months, but it is important just kind of knowing your options.
And the most important thing is communication. If you're ever struggling to make your house payment, contact them immediately and try to work something out. It's when we ignore those phone calls in the mail, it makes it more difficult. So, and then, you know, always try to pay that payment on time every time. That's the best.
The thing we stress a lot of the times is the sooner you reach out to somebody, the more options they have for you to pursue. So that's another big one. But thank you very much. That was a great question. Good talking about that. But I guess if there are any other questions, I'll be turning it over to Carrie. She will be going over some budget and preventive stuff with you guys. Thank you.
I'm Carrie. I also work at the home center. I'm also a HUD-certified counselor, homeownership counselor. Also deal with finances. And so if you all are starting this process to move into homeownership, we provide pre-purchase, we provide the education that is required for any down payment assistance, okay? Also, many loans require that you take our course. We are the only HUD-certified course in this area, okay? And then you meet with Nathan and he doubles down on where you are personally and come up with an action plan. If you need further help with your finances, working it out, budgeting basically, or credit, I'm here to help, okay? And so I am going to be trying to zip through all this in 20 minutes. So I'll be skipping stuff, but that being said, you can always call, you can always have an appointment. And so I'm just skipping stuff. Again, when you go to the lender, they are going to be all over your financial business. They are going to be requesting all kinds of paperwork. So be prepared for that. Sometimes they'll request more paperwork. It's key that any time they request paperwork, get it in as soon as possible, okay? Because it can affect the ability to close on a home or move forward. So, anytime I mention the word budget, almost everyone's eyes glaze over, okay? I hate the word budget. And I think it goes back to my past when I would fill out everything and it was like, how in the heck did I survive this month? But I always made it, okay? So I like to talk more about having a spending plan. A spending plan puts you in the seat. You are in charge of the money. You're making decisions. The whole goal of a spending plan is to help you not be living paycheck to paycheck. It's a miraculous thing. I get goosebumps talking about it. So with a spending plan, that represents, I hate to use the word prosperity, but it just represents financial security, where it's like, I don't have to worry about that anymore. Whereas the budget, it tends to be like, oh, my pockets are empty, you know. So that's what a spending plan is. These are the things that go into a spending plan. We are supposed to have a relationship with our money. And this happens by identifying what is important to me. What are my goals? What do I value? We're all different. Then we are going to look at how have we been spending our money? Has it been flying out the window? Well, maybe we need to dial it back a little. Also, just knowing all of the income that's coming in, all of the expenses going out, It's always based upon our current situation. We don't base it upon that raise, you know, or the new job. We base it upon where we are now. We put it together, spending plan. Life changes, right? So now all of a sudden the kids need braces. You got to figure that in. Or you did get that pay raise. Woohoo. So you're going to figure it in. And you do follow, track, and adjust. It's kind of a living, breathing thing. A financial spending plan truly can make the difference between financial success and failure. The spending plan is going to help us be prepared for the future, for those large expenses, okay? The annual expenses. In my past, I was always scrambling for the car insurance or the car tags or Christmas. I used to pay for Christmas with credit cards. Then I was paying it off for 5 months and all the toys were already broken. That was pretty frustrating, right? Yeah. So, yeah. So we're planning for those things, having a plan. We encourage savings. So important to have savings. Surprise expenses. How many times have you had something come up? It's like, oh man, what am I gonna do? I've been there. Accomplished goals. Maybe you have a dream to own your own home. You have to have a savings plan for that. Maybe you have a dream to travel to Europe. You have to have a savings plan for that. Maybe you just want to buy a tiny home for cash. You have to have a plan for that. Also, identifying wasteful spending. A budget is not about never having fun, okay? That's what I used to think. If I have to budget, I can't have fun. No, we can have fun for those things that are important to us. But we do have to put what I call a budget line on it. So in the old days, I did the envelope method. Has anyone tried that? It's pretty awesome. It made me very aware of where my money was going. For eating out, you can tell it was the old days. I would put $30 in that envelope for a month. Can't do that. Yeah. But once that money was gone, I was done. Okay. So values. When we have positive values, it means that we're comfortable with that money. Okay, we're not all stressed out. We spend and save wisely. So back when I wanted to become a homeowner, I had to do a lot of work. I was in a lot of what I call divorce debt. It took me 3 years to pay off that debt. I was raising 4 boys by myself. So, you know, the money, I learned how to make it stretch, I'll put it that way. So, but then I finally got a job that was decent, paid decent. We're moving forward. And I didn't want to be at the risk of landlords anymore. You know, all of a sudden, oh, we don't want to be landlords anymore. We're selling the house. That was awful. So I did a sheet called, Does Your Money Have Wings? I valued home ownership at that time above anything else. When I did that sheet, I realized I was spending over $1,300 per year on fancy coffee. That stunned me. It's like, oh my gosh, I just drank $1,300. And because I valued homeownership more, I did give up the coffee. But that was worth it, man. Now, would I give up Netflix? No. So, you know what I'm saying? It's about finding those things that are important and you make your decisions based upon that, planning for it. I value my retirement savings more than eating out 3 times a week. Now, you can tell I love food, okay? I love fast food. I love all the bad stuff. I don't know why. I wish I didn't, but I do. But I have to limit it. I don't want all my money going out the window for fast food. I would rather feel financially stable instead of, I was always on the brink of catastrophe before, but by employing these things, I feel so much more safe and secure. But I have met people who truly value buying stuff more than anything else. And that's kind of sad. I've worked with people that make over $300,000 a year. If they lost their job tomorrow, they would be homeless because they have so much debt. It's crazy. So figuring out what matters, sometimes it is psychological stuff that's causing us to spend like that. So we may need to get help. But I've been there. So, and then just quickly again, everybody has different goals. Everybody has different values. You base your spending plan upon that. Not about a cookie cutter thing that someone said, hey, you have to do it this way. It's not that way. It's about you. We want you to be the financial, or the captain of your financial ship. But you in charge. So kids these days, they expect a lot of stuff. My grandson wanted me to buy him a Nintendo Switch. Then I saw the price, I'm like, no. Back in the day, my dad told me, Carrie, I will cover all your needs, but that extra stuff, you have to get a part-time job and pay for it. Best lesson I ever learned. We can still do that with our kids. Plus, they will value and take care of those things more. I've had my kids carve their initials and stuff when it was brand new. I bought it. They didn't value it. So, yeah. So it's about teaching some of those things with your kids, learning to save. Kids these days, I'm always hoping a kid will knock on my door and say, can I shovel your walk? I would pay them $50. So maybe not that much.
Dang, but I was going to say I'll shovel.
Yeah. But that's the thing, you know, kids can work. And for us, I have a friend, he and his wife needed new hiking boots, you know, but they're already got their money kind of spent already. Instead of charging on a card, they saved for the hiking boots. And they were so proud that they saved for the hiking boots. So it's just changing that mindset. Tracking expenses. These days we swipe, we don't pay attention. So trying to find new ways to keep track of it. Some people keep receipts. They review them every week. I am not that good. My card just ended up with a bunch of paper in it. So I figured out what works for me. I ask for a receipt for everything, but then I pause and I look at it. It's like, oh my God, I went into the dollar store to buy 3 items and I spent $18. And so it's about just being aware. So now I grounded myself. I'm not allowed to go to the dollar store. I'm done. People have gone back to writing, keeping notebooks, writing everything down. Very important to always review your online bank statements. If you need to print them off and highlight with colors to figure out where is my money going. And that's what I do when I highlight. It's like, this is how much I spend on eating out, how much on the house, blah, blah, blah. Some people are great at spreadsheets. I do have an awesome spreadsheet if you want one, okay? Already set up, how easy is that? And these are some of the apps, awesome apps. Your bank probably has an app. It's incredible how much things have changed. I love online banking. I love the apps they give me, and they're free. Some of these are free to begin with, but to upgrade, there's a cost. Oh, this is that find the money sheet. So it's just an example. How much I was spending on coffee. This is back then. I think it's more now. $5 times 5. And so, but it's thinking about how much are we spending on snacks, movies, tobacco, eating out, cell phone, internet. Sometimes we can downsize the plan we have, or be like me. I call every year and say, I want the same plan the new people are getting. And they will usually give it to you, because if they lose you, it's more expensive to get a new client on board. So think about that. And, you know, thrift stores. So building the spending plan, writing down all your sources of income, pay yourself first. This is what we call savings. Commit to an emergency fund. This is the #1 thing I encourage everybody to have. All financial experts will say, have an emergency fund, $500 to $1,000. This will help us not charge on our credit cards, okay? That is the first and foremost thing we save for. And if you're able to save per paycheck, okay, I used to think I would save what was left over. I never did. I was online shopping at Zappos if I had any money, okay? So every paycheck, auto transfer over to our savings accounts. Write down all of those monthly expenses, the variable fixed. This is I call it the annual expenses. They might happen every 6 months, every 3 months, once a year. Christmas, count that as an annual expense. Figure out what's left over for the fun stuff. Okay, have a plan for it. I work with people that may be in large amounts of debt. I'm here to help. We do encourage people to work out a plan for that debt. You can work with me. There's an awesome app called Power Pay. Totally free. It's through an extension agency, which they have awesome resources. It has a really cool calculator on there to show how, as you pay off your debt, how long it'll take, and then how much money you'll have in your pocket once all that debt's paid off. But always have that emergency fund so you don't keep charging on the credit cards. So again, save smarter. I never knew this before. This changed my life when I realized I am allowed to have as many savings accounts as I want. If we give our savings accounts a name and a purpose, we're less likely to dip into it for nothing, or for Christmas, right? Or for birthdays, or for this or that. When I give my savings accounts a name, I love going online and checking what is the balance now. And it's like, oh, and then like my favorite one's vacation, but then I find myself, I don't want to spend my vacation money. It's the weirdest thing. So your paycheck hits the bank. Have an auto deposit of that paycheck, auto transfer to the emergency savings. You'll continue though to put into that after you get the 1,000, because we want it to grow into the 3 to 6 months to 8 months of living expenses. That fund is going to cover your house payment if something happens to a job. So during COVID, we saw people lose their jobs who never thought they would lose their jobs, and they were scrambling to find their rent money. That's what this fund is for, okay? Then other savings, like retirement, Roth IRAs, bills, okay? This is the goal savings. or the down payment for the house, vacation, college, those things. Entertainment, see, it's on there. But I've worked with people where this was number one. They were charging their rent on their credit cards. And yeah, everything was upside down. But we worked together and changed it, okay? I have given you examples of some budgets. This is an example of the annuals, how you figure that out. I cannot again stress the importance of savings. Savings is my safety net. When I did not have savings in my life previously, I was very stressed out. It was not a fun time, okay? I knew I needed to have it, but we were so poor at that time, the money was just paying bills. It was survival mode, okay? So, but as soon as I could, I started that savings. And I had a really cool side gig. I used to sing singing telegrams. It was so much fun, but I couldn't make enough money to support myself. But that money went into my, that emergency savings immediately. But so savings is so important. Emergencies, we already talked about that, all right. So does everyone here have a checking and savings account? Okay, because if people don't, sometimes the best place to start is at a credit union. It only costs 25 bucks. Oh, and look, my little mark's off. Yeah. Again, pay yourself first. Good, I get to skip over some stuff because I know I'm taking time. Also, we call, I teach a whole thing on about finding money. So changing W-2s, cheaper plans, but finding ways to make money without having to take a second job. But we can, if we've done a great job, ask for a raise. Sometimes it is about taking a second part-time job. Turn a hobby into a money-making venture. And sometimes I fell into the habit when I had the side gigs money, I would just spend it. So it was like free money. But once I got focused, I started putting it into my savings and all of my accounts grew, which was more exciting actually. Cutting expenses. So oftentimes financial experts will say, you need to cut 30% across the board. That can be very difficult. So I encourage people to focus on groceries, which I know is even harder right now with the way things are. But ways to focus on groceries, menu plans, grocery lists. And I know you live in Red Lodge. Are you allowed to order online and pick up your groceries here?
Probably.
Not
They,
the local market.
they did do that during COVID. I don't know if they still do.
Okay.
But
that's how, since I started shopping online for my groceries and I go and pick it up, when I am consistent and do it this way, I save $200 to $300 a month. Because every time Carrie walks into a grocery store, she overspends. It's like, that food looks good. So, I can't recommend that enough. Money gifts. So oftentimes, maybe we get gifts for Christmas, birthdays. Think about putting a portion of that into savings. Per cap, if you receive per cap, put a portion of that into savings. Tax returns, have a plan with that money. I had to have a plan with that money with the 4 kids. Most of it did go into savings right away. And it was divvied out through the year to cover clothing, shoes, sports. Oh my gosh. My daughter-in-law does great selling unused items on Facebook Market or something. She's brilliant. So there's all kinds of ways to sell unused items. So easy fixes. Focus on groceries, comparison shop, automate your savings. Try not to use credit cards just for usual spending unless you have it under control. Have to have it under control. Watch for sales and coupons, bundle insurance. The tough habits are usually eating out, stopping and getting the fast food, especially when you're working, you're tired. Try to switch to crock pot meals. It's awesome. Just identify and break those habits that are sucking some of that money out of your pocket. Free and expensive activities. We live in a beautiful area where we can hike, walk, snowshoe. You don't even have to pay to ski, you know, do cross country. I guess you have to buy the stuff, but still. Cancel unnecessary monthly memberships. I can't tell you how many times I've got the health club membership. 3 months later, I don't go, and I'm still paying. That's ridiculous. I quit doing that. So I think I forgot to print this off. Is it in this package?
Yes.
Yeah. So I want you to do that, not right now, because unfortunately we just don't have time. But I want you to think about what is important to you. What do you want to achieve? How much you're going to start putting into that savings account per paycheck. Credit. Everybody judges us by our credit score these days. So credit is the ability to borrow money. Sometimes it's called a loan, but we promise that we're going to pay that back, okay? The credit report, has everybody ever pulled their own credit reports in here? We recommend that every single person does it on a regular basis. Errors happen, or someone steals your identity. You have to be on top of that these days. So you can pull your own credit reports at annualcreditreport.com and find out what's going on. The credit score itself, so the credit report will tell people how you have been paying back your loans, your credit cards. The credit score looks at the history of all of that. They boil it down into a number. And a fact that I read was, so as you're moving into home ownership, you want to have a credit score towards 620, 640. Even better, you get better interest rates, okay? But statistically, people who have lower credit scores are more likely to default at some point on their loan. So that's why they really look at it.
I was just going to correct that number. So if you have less than a 660, pretty much not going to find a loan. So minimum 660, and you're going to be really limited on what options you have.
Unless it's a USDA.
Yeah, see, and there are loans and billings that will work with 640.
Yeah.
So, yeah. So, but there are some banks that won't work with 640. So be aware of that. That's always get the best that you can. Always work. Credit. If we don't have good credit, we can be denied a bunch of stuff. A cell phone, purchasing a home. Employers now will look. Renting an apartment or a car. Even bank accounts can be affected. Utilities. But most of all, when we have poor credit, there's kind of a stress that goes with it. I know when my credit was poor, I was stressed. So, FICO versus Credit Karma. Credit can be very complicated, and I'm just going to touch on this. There are dozens, if not hundreds, of different types of credit scores, okay? Lenders will use the Fair Isaac or FICO credit score, but even within that, there's some different scoring. Okay, it gets crazy. Credit Karma, who has a Credit Karma account? I do love Credit Karma. I use it as a gauge, but that score is not going to be what a lender pulls. Oftentimes what the lender pulls is way less than Credit Karma, okay? So with Credit Karma, you want to get that score way up into the high 700s if you can, okay? Just keep plugging it away at it. Credit Karma will also give you alerts if somebody opens up something in your name. My credit score recently dived by 100 points. I was like, what? I got in and looked, there had been an error. So I had to dispute it, and now it's back up. So that's why you have to pay attention. These are the 3 credit bureaus. Ooh. Just press on. Experian, TransUnion, Equifax. You can pull single credit reports from each of those agencies. The credit report is going to tell us who you are, where you live, your social security, date of birth, employers. Please be aware, errors happen here. Sometimes major errors. Important to look at that. Now, employers isn't so important. My credit report is still saying I work for Sharp Math. That was a little side thing I did on my own when my kids were babies. It doesn't even report what I'm doing now, but I'm not so concerned with that. But you need to make sure your name, address, social, and date of birth are correct. It's going to tell us what kind of credit cards you have, loans, how you paid on it, when it was opened. Public records, bankruptcies, foreclosures, they need to be dealt with. Now, tax liens and judgments don't show up on credit reports anymore, but you better believe the mortgage lender is going to search for that stuff. So if you know you have any of that in your background, it does need to be dealt with. Also, every time you apply for credit, they're going to pull your credit report. That is called a hard pull. It will ding your credit score. But then people that are wanting to offer you offers, they'll pull your credit, but it's a soft pull. It's not going to hurt your score, but then they'll send you offers and say you're pre-approved. You are not pre-approved. The minute you fill that paperwork out and turn it in, they're going to pull your credit. It's going to affect your score, okay? So the credit card is not, or credit, this is wrong. That should say credit reports. I just found a typo. You can go over this stuff so many times and then all of a sudden it's like, whoa. Checking and savings accounts do not affect your credit report, your income, your medical history, purchases made with debit or checks or cash. Doesn't show up on your credit report. Business account info, race, gender, religion, or national origin, or your driving record. That's good for me. I was just telling Nathan today I love to speed. I don't get caught very often. So this is what affects your credit score. Payment history is the #1 thing. If you miss a payment, not good. Payment history affects your credit score by 35%. Amounts owed. Nate talked about debt to income. They look at how much money you already owe. Length of history. So I got mad at my Target card and I was going to close it, but the lady was real smart. She was like, you've had this card since the beginning of time. If you close it, it's going to affect your credit score. I said, darn it. So I kept it. Types of credits: car loans, credit cards, student loans, and then new credit. So if you're out there applying for a bunch of credit all of a sudden, that can be considered a red flag. So we always tell people, if you are in the homeownership path, do not be out there buying new cars, racking up more debt, focus on that home ownership. We've seen loans get pulled, right?
I'm so excited about my new house. I went out and bought a new BMW. It's an $800 a month payment. You don't qualify anymore.
Or people quit their jobs, crazy stuff. So improving your credit score. So say you have some credit cards, some car loans, but your score isn't that solid. We want to get it up, right? So pay all bills on time every time. Number one thing, save $500 to $1,000 for that emergency fund so you don't have to keep putting that stuff on credit cards. Pull your own credit report, check for errors. If there are errors, dispute them, get it fixed. We teach use credit cards as a tool. They are never extra income. They are not savings. They are a tool to help build your score. One of my favorite financial people, she says, is your credit a slingshot to move you forward, or is it a shovel and it's burying you? So use credit as that slingshot. The way to do that is you pay it off, okay? Pay off your card, and then use it for one small purchase. Pay it off on time every time. You will see your score within 6 months going up, guaranteed. If you max those cards out, down. If you charge over 30%, down. Okay? It's a game. And we want you to be masters at the game, right? Okay, yeah, keep monitoring your score. So that's where Credit Karma does come in handy to make sure it is going up. Experian Boost is a new thing. I don't know exactly how it works. Do you know?
I am not familiar with it. Experian of the three is the one that has the most stuff to help you improve your credit. And they'll actually do employment tracking now as well built into their credit services. So lenders can just get literally everything about you in one go.
And Equifax was the one that got hacked not too long ago.
Oh, so yeah, right. I know.
Yeah.
So, you know, you have to pay attention to this stuff. But Experian Boost is a way, I think you pay a small fee, but they'll start reporting your rent payments, your utility payments, anything you choose. But the key is you have to pay it on time every time, and that'll help your Experian card.
One thing with Experian Boost, it'll help your FICO score, but not necessarily the tri-merged credit score from a home loan. So it's good for if you're like looking to get your credit up to maybe buy a new car or something, but not necessarily for a home loan.
Thank you for that.
Yeah,
because
I looked into doing it and I thought it was only for FICO. Like, well, I don't know if that's worth paying.
Yeah, thank you. I need to talk to that credit guy. Yeah.
And even aside from the app, you can actually call the credit bureaus and self-report your utilities, rent payments, etc. A lot of people do that. So.
I didn't know that. See, credit is just a beast.
And Carrie, maybe just a couple more minutes, just so Chris has enough time. And time for questions.
Well, yeah, because I guess you guys, if you have no credit, that's not necessarily bad, but you have to establish credit. That's all there is to it. You can get a secured credit card through a lender, or not a lender, through a bank or a credit union. Sadly, not a lot of them do it though, but it's backed by your own money, okay? $300 to $500. The key is charge one small thing, pay it off on time every time. If you max that secured credit card out, there goes your score. If you charge over 30%, there goes your score. Some people do credit builder loans or a small loan for something you had to purchase anyway. They use Experian Boost. Some people choose the authorized user method. You have to make sure whoever you're doing that with has good credit, pays their bills on time. Otherwise, it'll destroy your credit. So if you have bad credit, call me. That means you might have maxed out credit cards, all kinds of debt or collections. We can work out a plan. Oh gosh, see, I just had too much, guys, sorry. But again, use credit as a tool. That's the most important thing. Never as extra income, not as emergency savings. Never max out, don't charge over 30%. Okay, thank you.
Thanks, Carrie.
Should I turn this off?
Keep it running. This
Okay.
is where the sound is going. I'll just turn off the projector. Because I think Chris is gonna go old school. A little whiteboard. But thanks, Carrie. That's great. Also, if anybody wants crackers and cheese and meat, we've got a lot.
Just because she was ready to talk about credit, I'll just kind of start with some credit info in there. She talked about hard pulls on your credit affect your score, which is true. It is a very minimal effect. The important thing is with your two biggest purchases, your home loan and your car loan, when you do a credit check on that, say you're checking with Wells Fargo and they pull your credit, the credit companies now know that you're looking for a house or a car, and they will not count any other credit pulls for the next 45 days because they don't want you to not shop. So if you pull for a house, pull for a car, you've got a month and a half to shop around and have other companies do hard pulls, and it's not going to hurt you. Which is just one of the most important things. I know when I first started learning about this, that was something I was concerned about is, you got to choose the right company once. Hope you get it right. Credit freeze, you can call the credit bureaus and have them freeze your credit. This is to prevent when somebody hacks your information, they can't, go in then and open new loans because your credit is frozen. However, if you're going to get a home loan, you have to unfreeze it because if it's frozen, we can't pull your information. So it's one of those things just to kind of watch out for and be aware of is that you do have to unfreeze it, and you do have to unfreeze it for the loan process. Typically, we're going to pull your credit twice. Once when you first apply, just to see what your scores are, how you're doing, figure out what your rates are. And then at the end of the loan process, right before closing, we're going to pull it again to see if you bought a new car or gone to Home Depot and gotten a whole bunch of new appliances or anything that's going to significantly change what your standing is and if you still qualify. Because unfortunately, we do have loans that stop right at the end because they went and did something. So, and weird stuff too. Like, don't go get married before closing on your mortgage because sometimes that can affect things. And it all depends on your loan programs and what they're doing. Government loans. Don't get married before government loans. Wait till afterwards. Just pretend your life doesn't exist a month and a half after you're getting a loan.
That's true.
Yeah.
So my name is Christopher Downs. I'm with Movement Mortgage. I'm required by law to let you know my license number. In case I tell you anything really stupid today, you can let them know that was me. We're also supposed to let you know that we are not CPAs, we are not certified financial planners. I cannot advise you on your finances like she can. I can give you some general good information that I've learned from watching other people do really stupid things and really smart things. But at the end of the day, it's your money, your choice, and I'm not certified to do anything other than sell you a rate. Loan officer is literally a sales guy. We're going to look at all your information, and then we're going to sell you a rate on your house. Probably the number one most important thing that I'm going to tell you today is that the first thing that you should do when thinking about buying a house is to get pre-qualified. Before you get a realtor, before you start looking at houses, because if you get a realtor, the first thing that they're going to do is show you houses, is to talk to a mortgage company and find out what you qualify for. Most of us in our head have a very fuzzy relationship with numbers. So between a house that costs $50,000 and $1 million, most of us instinctively go, I cannot afford $1 million house. But $350,000 sounds reasonable. That sounds like a reasonable house. But just because it feels that way doesn't mean that you qualify for that. And a large part of that will actually be based on your interest rate. You would be amazed the difference between a 4% interest rate and a 5.5% interest rate could be $700 a month in your mortgage payment. Huge differences. So it's just one of those, find out what you qualify for. And even if you're doing, like you're building a house or you know that you're going to buy a house in 6 months, but rates are on the rise, which they've been doing lately, you can lock that rate now long term so that it stays right where it's at. But leave yourself open so if they go down, you can float with them, and there are options there as well. But pre-qualified, most important thing I'm going to say today. What determines your interest rate? There are a lot of things that go into that. Your credit score is a very huge part of it, but even that is fuzzy. The three of you could all have the exact same credit score and each get offered a different rate because of all the other factors. Because even though you may all have a 700 credit score, you've been late on mortgage payments in the past. Well, that's a problem because we want to give you a mortgage. Or maybe you had a bankruptcy 5 years ago, and even though that doesn't disqualify you from getting a house loan, it does cause issues with the rate. So there's just a lot of factors that play into that. Also, what they call the loan to value. So if your house is worth $300,000 that you're buying, and you're only taking out a loan for $200,000 because you happen to have a big old nest egg of 100 grand you're going to drop into this thing. So you're only taking out a loan that's worth 66% of the house. Your rate's going to be better because you're not maxing out that loan amount. Also, the term. Most of us know that a house, we think of a 30-year mortgage, but you can do 25, 20, 15, some weird cases 10. Those types of things can affect it as well. As far as the actual process of getting a loan, they're going to always start with getting pre-qualified. You're going to have to apply. So no matter where you go, applying is going to involve kind of like filling out a job application. They're going to send you a link. You're going to give them all your personal information. They're going to pull your credit. They're going to ask for pay stubs, W-2s, tax returns, bank statements, everything. We will know everything about you. And that's kind of when we go through and actually determine if you qualify. And it's very much one of those things where you can get a bank to send you a, pre-qualified letter like, oh yeah, they're pre-qualified for $1 million house. But find someone that's actually going to get your information and do the research and look through your paperwork, because they're the ones that are going to tell you what you can actually qualify for. And I have seen people that just apply and they go, oh yeah, they've got great credit. Sure, here's a pre-qual letter. You can get a $700,000 house. And then they start the loan process. And it's like, well, actually, based on your income, you qualify for $250,000. So it's important to know what you can get. And again, shopping the rate. Never just check with one mortgage company. Check with multiple. It's not going to hurt your credit, and you're going to find somebody with a better rate. And depending on where the market's at, the economy's at, that'll change. Sometimes your small banks, credit unions have the best opportunities for you as far as rates and what that looks like. Other times it's big, large mortgage companies. So like the last 2 years of COVID, interest rates have been down as low as 2.5% on a conventional loan. And the house has been getting bought left and right, which is driving the housing costs up. I'm sure everyone has noticed. Going with large mortgage companies is where you're getting all that value. They're going to have the lowest rates. They've got the crazy deals. But as soon as the rates started coming back up this year, suddenly all these small local credit unions were beating them out by a significant margin, 1.5 of interest. So just shop around, make sure that you check and see what's out there, what's possible. Common question I get in mortgage: what's the difference between an interest rate and an APR, annual percentage rate? Because we're all used to seeing like commercials for cars that say, oh yeah, 2% APR or whatever. So your interest rate, whatever that number is what's actually determining the interest that you're paying every month on your house. The APR is kind of a less useful number that is the culmination of your interest, your closing costs, your title fees, your every additional fee charge that you're going to pay over the entire 30-year process of that mortgage put into a number. So it's a number that in mortgage doesn't really affect you or help you in any way. It just kind of gives you an idea of long-term what the total numbers that you're looking at are. With that, there is an option. You will hear people talk about a mortgage called points. I'm gonna write this one down because it's a really important word that comes up. It's also used to trick you. So let's say that you apply for a mortgage and I go, great, look at everything, we can give you a rate of 5%. You have the option to lower that rate by paying for it. So you can pay 1 point, which in this case is 1% of the loan. So if you got a $100,000 loan, 1 point is $1,000. So you can pay down your rate to 4% by paying off 1 point. The reason that's really important is that sometimes what lenders will do if they are shady, and this is something to pay attention to, is they'll go, hey man, you know what, great, we're gonna give you a rate of 3.5%. And the two voices in your head say, that's awesome, and that is way lower than everybody else. That's weird, why? And what they don't tell you is the points. They're charging you 1.5 points, and you don't realize that because I haven't told you about it. You don't know what it is until you get that loan estimate, that piece of paper that breaks down all the costs. And then there's that line for points, and it says, hey, look, you're paying $2,500 extra in closing costs to buy down your rate. And you're like, what is this? So always pay attention to that. And sometimes they will hide it very sneakily, but anytime you see somebody giving you a rate that is significantly less than everybody else, ask them for the loan estimate. They legally have to give it to you. And look at the charges. A lot of times, one of them will be way higher than it should be. Like everybody else has a $600 processing fee, but they're charging you $3,000. Why? That's probably why. There are different types of loans. So they all have pros and cons. Conventional is just your standard everyday, this is a loan for your house. Then you have more specialty loans like USDA, which they deal with here for the habitat homes and whatnot. USDA loans are great if you qualify for them. I have one on my house because Red Lodge is a small enough population that you can get a USDA loan. And yes, it is that USDA. USDA loans typically have lower rates, but you also pay fees to have a USDA loan. Pros and cons, they all kind of have their things, but and then FHA is another big one, common that's used, and then VA, of course, being the fourth for veterans. FHA loans are typically great for if you have lower credit scores, if you have less money to put down on the house, things of that nature. So conventional loans are typically going to be best for people that have high credit, lots of money to put down. FHA are good for lower credit scores. If you have less money to put down, USDAs are just good, but you just have to qualify, and there are a lot of regulations on income and areas and all that stuff.
FHA is which acronym?
Federal Housing Association. Cool. I'm not prepared for these questions here. There are wonderful, wonderful things Carrie mentioned called down payment assistance. Pretty much every state has some sort of down payment assistance program that will either help you pay part or even all of your down payment. And then depending on the program, some of them set it up as a secondary loan. And as long as you don't move and you pay all your bills on time for the first 3 years, they'll just forgive the second loan, the down payment system. But absolutely 100% worth looking into. And if you qualify for one, there's no reason not to get one and take advantage of that. Most states have great ones. I've looked into Montana's and they're pretty good, especially for veterans. Actually, here really good. Speaking of which, standard down payment. So there was this mentality years ago of what a down payment was supposed to be, and so most of your parents, probably 20%. You're supposed to pay 20% of your house when you buy it. That's not a thing. If anyone tells you that, they haven't done it in a long time. Down payments range from 3% up to you bought the house in cash, and I don't know why we're talking. And it just depends on you and what you're wanting to do, what you can do. And then again, also the smaller the down payment, the more and more narrow your options will become in what types of programs and offerings you can get. And that will also affect, again, your rate, the amount your loan to value, how much of that house value are you taking out as a loan. But you can go as low as 3%, even on a conventional loan. I will tell you that any low down payment program, you will absolutely need to take the course with them. The process of getting a loan can be very quick or very slow. There are a lot of factors that roll into that, but a normal, typical person, which most of you guys would be, who works a W-2 job, gets a normal paycheck every 2 weeks. As long as all the numbers work, you can probably get a loan in 3 weeks, as long as you can get an appraisal done. And that is the #1 holdup on every loan, especially in Montana, because we are so spread out. A lot of times appraisals will take a month because it's just when is there an appraiser that can get to that area of town? We have no control over it. After the big housing bubble crash in 2008, they got really tired of people paying off appraisers and causing inflated housing values and other things that caused the crash of 2008. So now all appraisals go through third-party companies called AMCs, appraisal management companies. So we go, hey, we need an appraisal, and they go, okay, we'll get back to you. And then you just kind of wait until they go, we got a guy that'll do it in 4 weeks for this much money. Okay, great. Can we do better? But appraisals should typically be the biggest time sink, and it's about the only reason that you can argue with the seller to move a closing date and not get a lot of pushback, because there's no control. Nobody can help that. Nathan, I mentioned the DTI, the debt to income ratio. Typically when that's written out, and he had it, there are 2 numbers. Typically the only one that we care about is this one, which is your total debt. So this is your car payment, your credit card payments, your student loans, your everything, including the house payment that you're in the process of trying to get. Every loan type, every program will require a different number on this. So like VA loans, veterans, I have seen that number go up as high as 66%. Oh. It's VA loans have a whole different thing to them. Standard, typical, conventional loans, 45 is typically where it's going to be. FHA, USDA have their own numbers. But this is every debt you've got. And on the list of debts that you have that you want to pay attention to, the two that are the most important are your mortgage. If you've had a mortgage before, mortgage rates are never good. And to the point where if you have mortgage rates within a certain time period, you can't get another mortgage loan. They just won't do it until it is seasoned out. The other one that I have seen absolutely wreck a loan process are student loans that are in forbearance. If your federal student loans are not being paid, and so they've been flagged as a problem, that can really mess up loans. It's fine if they're deferred. All student loans are deferred at some point or another. Some of them are deferred for literally forever. But yeah, those are the two big ones to just kind of watch out for and pay attention to. The big thing about the 20% that people used to talk about is something called PMI. But mostly you'll just hear referred to as MI, which is mortgage insurance. So if you get a loan that you have borrowed more than 80% of the loan to value, anywhere between 80 and 97, you are required by law to get mortgage insurance. One of the mortgage insurance is that if you fail to pay your loan, the insurance helps the lender get some of their money back. Now, once you hit 80% of your house's loan to value, you can call the company and say, hey, please remove the MI. We have reached the 80% mark, we're good. If you forget, or you don't think about it or don't calculate it, they are required by federal law to remove it at 78%. Either way, it will go away. Now that is somewhat different than like the USDA fees and things like that that are built into those programs. But typically speaking, loans, you will need to get mortgage insurance. And then I want to talk to you about something that if you've never had a house before, will probably shock you the first time you get a mortgage statement in the mail. So in your head, you're thinking, I owe $1,200 a month in mortgage. On your mortgage statement, that's going to be broken down into 4 things. So your principal, which is the amount of money that's actually paying on the loan that you borrowed. Your interest, which is the interest, and then escrow, which if you've ever heard is a weird word, I still don't know how they came up with it, but that is 2 things. That is your taxes and your insurance. And that's how your loan is going to be broken down. Now, what's going to happen is the very first time you get a mortgage statement, you're like, I owe $1,200. Now, you already know that taxes and insurance is going to be, I'm making up numbers, $200 of that. Okay, great. So now you owe $1,000. And what you're going to see is that $300 is principal, $700 is interest. And that's going to freak you out. And you're going to be like, why am I paying so much in interest? So over the course of a 30-year mortgage, that $1,200 isn't, well, this amount is not going to change. The principal and interest will always be the same for 30 years, $1,000. Of course, your taxes and insurance will fluctuate. But over the course of the 30 years, these 2 numbers are going to switch. And they will slowly lower and raise to where your principal is being paid significantly more, your interest less. But just don't be freaked out the first time you see that and go, oh my God.
Because the lender wants theirs first.
Basically, right? Yeah. They have calculated out the 30-year mortgage, exactly how much interest they're going to collect. And then they have spread it out, declining across that. And you'll see that number too on your loan estimate or your closing disclosure, which are basically the same document, except one of them is given at the beginning of a loan, the other is given at the end of a loan. The closing disclosure is the accurate final numbers that you're going to pay. The loan estimate at the beginning of a loan is just, it's going to be somewhere in here. But on both of those documents, you will see somewhere on their line that says loan 200,000, and then something like total collected 350,000. Because with interest, that's how much you'll pay by the time it's done.
Unless you pay on the principal, like if you pay
Unless
extra.
you pay on the principal. Yeah. So you can always pay extra and just put a line item note, this is for principal.
Yeah.
And that will affect your rate. If your mortgage company is good, your loan officer is good, they can usually provide you a spreadsheet that breaks down your payments for the entirety of the mortgage with a line where you can plug in extra principal and it auto adjusts what the rest of your loan history looks like. She kind of covered this, the don't do's while you're getting a loan, just don't do anything. No expenditures, don't max out your credit cards. Any significant changes in your credit will show up when we check your credit again 2 days before closing, and they will halt your loan 2 days before closing and go, we need to recalculate. You may not qualify anymore. Something else that you will see that will happen that if you were not prepared for will make you go, whoa. At some point in time after you get a loan, you will get a piece of mail. I was going to say a piece of mail in a letter, and that didn't make sense. That's going to say, hey, we're your mortgage company, and we're no longer your mortgage company. We have gotten rid of you. And this is completely normal, but mortgage companies sell off the loans. So they will take it, they'll package them up and sell in bundles to other mortgage companies. Everybody's loans are just bouncing around the country right now between financial institutions.
One of the best businesses in the world. Buying and selling debt.
Yeah. So, and then within about 2 weeks of that, typically you'll get a secondary letter saying, hi, we are now your mortgage company. So typically when this happens, you have 60 days without them touching your credit, even if you're late, because the transfer process can cause issues. Sometimes you have a PO box and you check your mail once a month. And so your payment still went to the old company. And the old company, instead of forwarding it or returning it, just shredded it and didn't tell anybody. So weird things happen. So they expect that. So when the transfer happens, you have 60 days of everyone just going, we're all going to stay calm. Everyone will be fine. But in general, the rule with credit and mortgages is if you pay by the 15th of the month, you're not late. If you pay after the 15th of the month, you're late. And if you pay after 30 days, that's when they will ding your credit. So as long as you pay within the month, they're not going to hit your credit, but you will have a late charge. And the other note that I had on here is about title insurance. A lot of people ask me, do I really need to get this? Because when they see that $1,500 on their closing disclosure, they're like, do I need to pay that? And the answer is yes. It's for you and it's for us. Because let's say that when the house is being constructed, the builder contracted third-party Joe's cabinetry to come in and put in $30,000 worth of cabinets. But the builder was a jerk and he never paid Joe. So Joe can put a contractor lien on your house, and he now has more possession of your home than you do. So title insurance makes sure that whoever lent you the money stays in the first position on your house, which is you, and that nobody else can come in and supersede that for any reason. So title insurance is super important. I've heard stories from title companies I work with about people that show up 20 years later. And like, I did a job for the owner 3 owners ago, and I never got paid for it. So I'm putting a lien on the house. Because it doesn't matter if you own the house when this happened or not. What matters is the property and that they did work on it. And so title companies mitigate and they take care of that to make sure that you don't A, pay for it, or B, get your house taken from you by Joe. Yeah, that was all the notes that I had for just kind of basic loan process and things that you'll see. Any questions? Random thoughts?
I know you said it's worth it to shop around to find a good rate. How much of a good strategy is it to go, well, Merrill Lynch over there gave me this rate. What can you guys do? This ain't a good rate. Come on.
Completely worth it.
Yeah, completely worth it.
So
pit
if somebody
companies against each other, essentially.
Yeah, absolutely. So the biggest thing is that if Merrill Lynch gave you that rate, get the loan estimate. Because whatever company you're talking to, unless they see a Merrill Lynch loan estimate, you're
just blowing smoke.
Yeah. But if they see the loan estimate, they might go, hey, you know what? They did give you a better rate. Here's where they hid the points that they're charging you that they didn't tell you about. And here's what we're doing and why this is a better deal.
Right. Sure.
Or they may go, hey, I see it. Let me talk to my people and see if we can't match that. But yeah, absolutely worth it to pit them against each other.
Yeah.
So
cool. Thank you.
Just don't do it.
Right. Right. We're on the same team.
Yeah. No question. Concerns, thoughts? Good.
What company did you say you're from?
I work with Movement Mortgage, and
Okay.
I've got a stack of business cards over there.
And that's an 8, not a D, the second number or letter?
That's an 8. Yes, my 8s are terrible.
Oh, wow. Okay.
Yeah.
Oh,
That is definitely not what I wrote down.
Yeah.
So is that a 1, 8? Then? Yes. Or is that okay? All right.
Thanks for asking.
I can do this when I really try.
Oh, there we go.
Nice. Yeah.
Good job. I'm so proud.
Well, I know we're a little bit past this 6:30 mark, but any other questions just for any of our presenters today? It was a lot of information. But yeah.
I had a few for Carrie since we kind of ran out of time. You talked about that you have a spreadsheet that we could get from you.
Oh, yes. So
And
you could email me. I will get that to you. So does everyone want a card from me and Nate?
Sure. I would like, cards from all of you.
And Carrie, if you email me that spreadsheet, I can just send it.
Okay, that sounds great.
Okay.
Did we need to sign up somewhere? Someone had
You want one?
info about this.
I'll take it down because I don't think I have.
Even though I know you.
Right.
I was like,
You bet.
Yeah. If you have any questions, feel free to give me a shout or email.
is your office here in Red Lodge?
Yes. My second bedroom is here in Red Lodge. Yeah, I'm local here. I work here.
Okay.
Per cap. What is per cap? Many of our Native American people receive per cap. And it's like maybe every 3-4 months. It depends on what's going on. Sometimes it's $200 per person, 400, but some tribes don't receive anything.
Okay, so it's just it's money that comes from somewhere that some people get. That can be part of so use for savings. Okay.
I was wondering
kind of like disability or things like that. Like I get a small amount of disability.
Okay. Yeah,
so
it could be. But it's tribe.
Yeah.
Based upon tribe.
Okay.
Yeah.
All right.